What if I told you that while most people are chasing the next hot stock, I've been quietly building a portfolio that pays me every single quarter, rain or shine? In the past year alone, my dividend ETF strategy has generated over $12,000 in passive income. And today, I'm going to show you the exact weekly process I use to pick the highest quality dividend ETFs that could potentially do the same for you. I'm going to break down my 5-step weekly screening process, reveal the specific criteria I use to separate the winners from the losers, and share 3 ETFs that are currently on my watch list right now in July 2025. But first, let me ask you this. How much passive income would change your life? Drop a number in the comments. I read every single one, and I'll be sharing some of your responses in next week's video.
Here's the thing most investors get wrong about dividend investing. They think it's just about finding the highest yield possible, and that's exactly how you lose money. A dividend that is massive, think more than 8%, may signal that it's unsustainable. And when that dividend gets cut, your principal gets hammered too. That's why I focus on dividend ETFs instead of individual stocks. ETFs give you instant diversification, professional management, and most importantly, they smooth out the volatility that can destroy your income stream. But not all dividend ETFs are created equal. Some use risky option strategies. Others are loaded with debt-heavy companies, and many have expense ratios that will eat your profits alive. That's where my weekly strategy comes in. Every Sunday morning, I spend exactly 45 minutes running through my 5-step screening process. This isn't about timing the market, it's about staying disciplined and catching opportunities when they present themselves. Step 1. The Yield Sweet Spot Analysis. I start by filtering for ETFs with yields between 2.5% and 6%. The best dividend ETFs strike a balance between high yield today and growth tomorrow. Anything below 2.5% isn't worth the effort, and anything above 6% raises red flags about sustainability. Step 2. Expense Ratio Reality Check. I filtered out ETFs with expense ratios above 0.5%, as high fees can erode any gains over time. My sweet spot is under 0.20%, with my favorites like SCHD and VYM coming in at just 0.06%. Step 3. The Diversification Test. I look for ETFs holding at least 50 companies, but preferably over 100. This spreads your risk and protects you if one sector gets hammered. Step 5. The Fundamentals Deep Dive. Finally, I analyze the underlying holdings. Are these profitable companies with sustainable business models, or are they yield traps waiting to collapse? Based on my latest screening, here are 3 ETFs that are checking all my boxes right now. Number 1, Schwab U.S. Dividend Equity ETF, SCHD. This is my personal favorite and largest holding. SCHD holds 101 stocks of high-quality dividend-paying companies. It generated an annualized 3-year return of 8.32% and a 5-year return of 13.43%. What I love about SCHD is its quality focus. It doesn't just buy high-yield stocks, it buys profitable, growing companies that happen to pay good dividends. Number 2. Vanguard High-Dividend Yield Index ETF. VYM provides exposure to more than 500 stocks, providing a great deal more diversification than SCHD at the same expense ratio of just 0.06%. While this extra diversification means investors will bring home a slightly lower yield at around 3%, you're getting broader market exposure and lower volatility. International Option. Vanguard International High Dividend Yield Index ETF. VYMI trades under the ticker VYMI and earns a Morningstar Medalist rating of Silver. For those wanting international diversification, this gives you exposure to dividend-paying companies outside the U.S. Quality Focus. Fidelity High Dividend ETF, FDVV. The fund tracks the Fidelity High Dividend Index, a portfolio of large and mid-cap U.S. stocks that can hold some stocks from international developed markets. This one balances income with potential for price appreciation. Before you start building your dividend ETF portfolio, let me save you from the mistakes I see investors make every single week. Mistake number 1, chasing the highest yield. I cannot stress this enough. If the dividend is unsustainable, the fund's price will likely decline over time, meaning you'll end up a net loser on the investment. Always prioritize sustainability over yield. Mistake number 2, ignoring expense ratios. A 1% expense ratio might not sound like much, but over 20 years, it can cost you tens of thousands in lost returns. Stick with low-cost options. Mistake number 3, no diversification strategy. Don't put all your money into one ETF, even if it's performing well. I typically hold 3 to 5 different dividend ETFs to spread sector and geographic risk. Mistake number 4, timing the market. As we move into 2025, certain high-dividend yield ETFs are garnering increased attention due to their consistent performance, strategic asset allocation, and competitive expense ratios. The key is consistency, not timing. Dollar-cost averaging into quality dividend ETFs beats trying to time perfect entry points. Mistake number 5, forgetting about taxes. Dividends are taxable income. Make sure you're maximizing your tax-advantaged accounts before building dividend portfolios in taxable accounts. Here's how I actually structure my dividend ETF allocation. This isn't financial advice, it's just what works for me. Core holdings, 60 to 70%. SCHD and VYM make up the majority of my dividend allocation. These are my steady, reliable income producers. Satellite holdings, 20 to 30%. Higher yield ETFs like SPYD for extra income and international exposure through VYMI for diversification. Opportunity Fund, 10%. I keep a small percentage in cash for when exceptional opportunities arise, like when a quality dividend ETF gets beaten down unfairly. Rebalancing schedule. I review and rebalance quarterly, not weekly. Too much tinkering can hurt your returns through transaction costs and emotional decision-making. The key is to start simple with 1 or 2 core holdings, then gradually add complexity as your knowledge and portfolio size grow. There you have it, my complete weekly strategy for picking high-dividend ETFs that actually work. Quality dividend ETFs focusing on companies with strong profitability, management efficiency, and cash flow can provide the foundation for a robust passive income stream. If this strategy helped you, smash that like button and subscribe for more weekly dividend investing content. I post new videos every Tuesday and Friday. In the comments, tell me, which dividend ETF are you most interested in researching after watching this video? I'll pin my favorites and might even do a deep dive video on the most requested ones. And if you want my complete dividend ETF screening checklist that I use every Sunday morning, I've put a free download link in the description below. It's the exact template I showed you today. Until next time, keep building that passive income, and I'll see you in the next video.